Luke, that was great. I want to bring some data points to what you're saying. The first is this. This is a New York Times headline. China is buying gold like there's no tomorrow. And as you were saying there, Luke, this looks like to be mostly physically settled. The global price of gold has reached its highest levels as Chinese investors and consumers buy the metal at a record pace. There's another tweet. I think I found this on your timeline as well. This is the start of de-dollarization. This is a graph showing the share of China's trade that's settled in RMB, just China's currency. And for the very first time in March of 2023, the RMB share of trade for cross-border payments overtook the dollar in terms of the currency that China uses for settlement. And there's also this. China has a competitor to the SWIFT system, which Bankless listeners will know what SWIFT is. It's basically kind of like the global payments system that is like primarily US and allies controlled. China has a competitor to that. And they did last year in 2023 over 17 trillion in business volume. So you could start to see the eroding of the dollar supremacy in this type of a world that is repricing like currencies at the base level, at the energy level. I've heard you say this too, Luke, and I want to ask the question of how does the U.S. react to this in terms of its monetary system and like what happens next. But you've said this, the U.S. has a choice to either bail out the currency or bail out the bond market. And this to me is kind of the crux of where we are today. And what they choose or how much they choose on one side or the other will probably determine many of the outcomes of what this monetary system change actually looks like. But what do you mean when you say the choice is between bailing out the currency or bailing out the bond market?
In essence, what this evolving new monetary system does is leave insufficient foreign demand for treasuries and exponentially rising supply of treasuries. And in any asset class, if you have more supply than demand, you're going to have the price go down. Well, when the price of a treasury goes down, rates go up. This wouldn't be a problem, except the United States has run up $35 trillion in debt, a lot of it doing things that in hindsight weren't very advisable. They weren't very good uses of money over the last 25 years. Iraq, Afghanistan, bailing out Wall Street the way they did, Syria, I could go on and on. Anyway, the issue is there is a rate where this supply-demand mismatch of treasuries that is being caused and reinforced by this monetary system change in terms of who's reserving what as a reserve asset for net commodity surpluses. Do the Fed and Treasury stand aside and let the market set the interest rate for them? And if they do that, rates are going to go up and up and up, and everything else is going to go down and down and down, and the dollar is going to be the strongest currency in the world. There's almost no limit to it. And that is basically defend the currency. Now, the problem, of course, is that at some point, not too far down the road in that process, U.S. interest expense will overtake U.S. tax receipts, because U.S. tax receipts, as it turns out, are very interest rate sensitive. So as interest rates go up and the dollar goes up, tax receipts are going to go down non-linearly. Interest expense will go up non-linearly. And not too far from here, interest expense alone will be more than U.S. receipts, at which point either the United States will default on treasury bonds or they will print the difference. They will print the interest. And that's also known as hyperinflation. That's if they stand aside and do nothing and let the currency be strong and let the bond market take the hit. That's not going to happen. What's going to happen, what has happened repeatedly and at ever shorter intervals since the repo rate spike of September 2019, is rates will hit a point, bond volatility will hit a point, and then Fed and or Treasury will come in and cap U.S. Treasury market volatility to prevent further Treasury dysfunction. They do that by injecting dollar liquidity, which then weakens the dollar, reduces rates. Basically, it's sort of a temporary version of yield curve control. And in that case, the release valve is the currency, inflation, asset prices, etc. And we've seen them. They have, it's almost biblical, right? Where Peter denied Christ 3 times. Well, the Fed and Treasury and or Treasury have come in and capped bond treasury market volatility 1, 2, 3, 4, 5 or 6 times since September 2019. So at any point in time, they could theoretically not do it. They're never going to not do it. They could let markets twist in the wind a little more than they have. But again, unless they're willing to let interest expense crowd out defense and entitlements and then ultimately overtake tax receipts where they have to, it puts them in a very bad position, that's not going to happen. So they will, in my view, continue to choose support the bond market at the expense of the currency.
Support the bond market at the expense of the currency. So every time they're making that choice, are they sort of just like printing money? Like who wins and who loses in these scenarios here? And the scenario you predict most.
Look, you could call up a chart of the S&P 500 over TLT, long bond ETF, over the last 5 years. It looks like this. You call up NASDAQ over TLT.
This is Luke.
We're looking at
for
hockey
listeners.
sticks.
Yeah, hockey stick up.
Hockey stick up. Bitcoin over TLT. Hockey stick up. Gold over TLT. Ever since global central banks stopped buying treasuries, started buying gold in 2014, it's an exponential hockey stick. That is because that describes who wins and how they win. Home prices over TLT over the last 5 years. If they're going to support the bond market over the currency, markets are reflexive and they learn. They're going to figure out, okay, they've done this 5 times now. Why bother with treasuries? Treasuries underperform when markets are selling off, like today. Someone texted me this morning. Zeros, long end zero coupon bonds have 4x the beta today of the NASDAQ 100. 4 times the beta on a down 300 Dow day, right? Okay, so stocks are down and treasuries are worse. Okay, well, when they inject money, what outperforms on the upside? Treasuries or NASDAQ? Well, that's an easy one, the NASDAQ. So when stocks are down, then long bond does worse. When stocks are up, the long bond does worse. When, same thing with gold. Stocks are down today, risk off today. Gold is outperforming treasuries, long-term treasuries. When they inject the money, which they inevitably will, gold outperforms on the upside. So you can see it reinforces and accelerates this sovereign problem, which is not enough demand for treasuries. So basically, what wins is everything but treasuries. And what wins is inflation. What wins is nominal GDP growth. What wins is increasing political instability. What wins is the 1% and the 0.1%, the people with the assets. And that's what we've been watching for 5 years, and I think it's going to continue accelerating.
You said the U.S. will be just like Japan, but feel like Argentina. Can you explain that? What does that mean?
Yeah, I mean, you can read any number of strategists and economists and investors who said, well, Japan's got way more debt than us and they're fine. And of course, they've gotten a lot quieter in the last 3 to 6 months when all of a sudden the whole Japan's fine thing is not working out so well. But they had a point as long as you don't dig into it at all. Japan does have more debt than us, but Japan has a positive net international investment position of like 65 or 70% of GDP. In other words, they have a foreign piggy bank of 70% of GDP. They own more assets overseas than foreigners own of them. They finance internally. In other words, their own people finance them. So that's a really big deal because if you've got a lot of debt and you pay them 0%, but you're in deflation, people are happy to make 1% or 0% on a bond if their cost of living is going down 1 a year. Your standards of living are rising. No one's complaining. Your bonds are buying you more money every year. Real rates are positive. The United States is externally funded. We don't have the option of having a 0% coupon on rates. And certainly not having deflation. We can't afford positive real rates. We need negative real rates, which means we need to steal money from the people who are our bonds. We need them to hold bonds while the real value of those bonds declines in energy terms, like we've just discussed. That's very different. And then lastly, China runs a current account surplus. They got more money coming in every year. We run the twin deficit by virtue of the system structure. We got money going out. We got big deficits to finance every year. So there's a chart I've showed before. It shows that the Bank of Japan's balance sheet as a percent of GDP just hockey sticking, and people say, well, we're just going to be Japan. I'm like, yeah, sure. The Fed's balance sheet's going to hockey stick just like the Bank of Japan's. And the easiest way to frame up why it's going to feel like Argentina, right now the Fed's balance sheet's, I don't know, 35% of GDP, 30% of GDP. I don't know. Bank of Japan's like 110%. Imagine if I told you that in 5 years, the Fed's balance sheet was going to be 70% of US GDP. So 70%, that's 1.4, 1.8. Okay, so that's about 18 trillion more. Fed's balance sheet's going to be $25 trillion in America in 7 years, 5 years. Is that inflationary or is that deflationary? Is that Japan or is that Argentina? It's Argentina. It's 100% Argentina.
Sounds kind of bad.
What's bad? What's bad, right? Like what's normal for the spider is chaos for the fly. That you own a bunch of long bonds, yeah, you're going to get paid every dollar you're owed if you own a bunch of long-term treasuries, but they're going to go from buying you, diamonds to buying you cubic zirconia to buying you Cracker Jack on a string. Because you know what? You didn't react fast enough.
Luke, if you enjoyed all of that, then you'll absolutely love the Bankless newsletter. Join over 300,000 fellow readers, all for free. Click below to sign up.